Hi, this is Ken Boyd with the Accounting Accidentally website. Here on the home page, you'll find links to over 300 blog posts, and if you slide down to the middle of the page, over 400 YouTube videos. I wanted to talk about a topic that is tough for accountants, and it's capital budgeting. And this relates to future value, present value, and related topics. So what I have here is an example that I hope will explain some of these tough topics. So let's talk about Levi's is a manufacturer and they need to buy a sewing machine. The cost is $10,000. And if they buy the sewing machine, their cash inflows will increase by $2,000 a year because they'll operate more efficiently. The useful life of the machine is 6 years and the annual rate of inflation is 5%. It could also be stated as the accepted rate of return is 5%. And what I think is helpful here is to set up an analysis like this where we have cash inflows and outflows here, where in year 0 at the very beginning we pay $10,000, and for each year for 6 years we get $2,000 of inflows. We multiply this column by the present values, and you can find these tables online and on present value tables. And obviously the further you go out in terms of years, the lower the percentages get. And if I multiply across, for example, here, you'll see how I get 1904, 814, etc. And the point here is that if you add up the present value of the cash inflows and outflows in blue, you'll get a positive or a negative number. And the rule of thumb is that if you get a positive number, the inflows outweigh the inflows are more than the outflows, you should do the project. In this case, it's a positive number. You should go ahead with the project. You're better off. And if the number's negative, you should not do the project. Now, you'll also note here in red that if I click here that when you get to year 5, the present value is still negative. It's not until you add in year 6 do you get to a present value amount. So that the total, the subtotals can be different along the way. It turns out that after 6 years, this is a positive number, present value, and that you should do the project. Payback period is another number that's a little easier to use, and payback is simply the original investment, the $10,000 sewing machine divided by the dollar amount of cash inflows that you get from being more efficient, 2,000, it's 5 years. And I have a note here that says the cash, this is based on cash return, but these cash returns each year for 5 years are not based on today's dollars. In other words, they're not adjusted to present value. What I have here on this slide is you can have uneven cash flows. So this is the original discussion with even cash flows, but you can also have uneven cash flows, which is what I have down here. Well, what if the payments are uneven? For example, what if you only get $500 the first 2 years, $1,000 the second 2, and then $3,000 and $4,000 in later years? Well, the average is $2,000, but if you multiply all of these by present value, you may actually end up with a negative net present value number. The last thing I wanted to mention is the accounting rate of return, which is flips the ratio. The average cash inflow of $2,000 divided by the investment of $10,000 gives you a 20% accounting rate of return. So those are some key points on cash budgeting. If you go over to the conference room page, next year I'm coming out with 25 intermediate accounting spreadsheets and how to use them. Well, you'll get a book with 25 examples that combines a written text with screenshots from my spreadsheets. You'll get the spreadsheets themselves, and you'll also get the YouTube videos that explain the content all in one book. Comes out in January of 2020, and if you'd like sample chapters, email me at ken@stltest.net. Thanks very much, and we'll see you next time.